Hello, I'm going to talk with you about the other most important part of chapter one, which is the financial statements, the basic financial statements, the income statement, the statement of retained earnings, and the balance sheet. Later on, the chapter talks a little bit about the statement of cash flows. That's a little more in-depth statement. And so actually, you typically do that statement when you start the next accounting class, managerial accounting. But basically, for now, going to look at the income statement, statement of retained earnings, and the balance sheet. Last time we looked at all the transactions, so going to kind of build on that what we talked about with the in our discussion of the accounting equation. So let me go ahead and share the screen and going to open up the file here. And as you can see, basically, if you remember, basically last time we looked at the accounting equation. We looked at what the accounting equation was, how it should always be in balance, assets equal liabilities plus equity. We looked at some transactions and kind of how they fit into the accounting equation. And one thing I did do is you see I basically just brought down the totals here to the very bottom for all of these different account balances. And of course, when you watch that video, when we did after we recorded these transactions to the various accounts, the accounting equation was in balance. Now, what companies typically do is all during the month they record the transactions in a similar manner to what we looked at here. And then at the end of the month, they want to see, okay, how did we do? What was our performance? What does certain account balances look like? And so they create the financial statements. And so this chapter kind of introduces us to to the three main ones we're going to look at now. And like I said, later on we will look at the statement of cash flows, but the income statement, the statement of retained earnings, and the balance sheet. Now, I went ahead and completed them, but I'm going to kind of walk you through them, talk about them some, and kind of how they came really from all the totals that we just put in, or that we just did with all the transactions that we just recorded when we were looking at the accounting equation. Now, the first financial statement would be the income statement. And the income statement, basically what it does is it looks at, are your revenues greater than your expenses for a period of time? The income statement basically normally will either cover a month or a year. Or companies will typically do both. They'll do one for each month, and they'll do a big one that kind of recaps the year and their financial performance. Now, one thing as I'm talking about the financial statements, you always want to do them in the order that I do them here, or show that I'm showing you here, because what you'll find is that there's a number on the income statement that's used on the statement of retained earnings. And then the statement of retained earnings balance is used on the balance sheet. So you want to do this order: income statement first, retained earnings second, and balance sheet third, just like we're talking and doing them here. Now, each financial statement is going to have a heading. And so notice here I put in the name of the company, the name of the statement, in this case, the income statement, and the period of time it covers. In this case, for the month ended January 31st, 2021. So basically, this income statement covers the entire month of January. Now, notice that it starts off with revenues. So what we're going to do is we're going to take what was our total revenues for the month. And basically, this total right here comes from basically our total revenues at the end of the period. And so basically, I bring that over. Now, in this case, this company only had one type of revenue, which was a service revenue. Sometimes companies, as you'll see, have different sources of revenue. Maybe interest revenue, rental revenue, maybe they got a building and they're using part of it, but renting off another part of it. So companies could have different sources of revenue, but for this one, we're just looking at one. And then we're going to list our expenses. And again, this comes right from the bottom line when we were setting everything up, salaries expense. And so we're going to use that total right there. So in this case, I've only got one expense because I just wanted to give you a basic example. But typically companies will have many different expenses. Like I said, salaries, what they're paying their employees, rent, what they're paying for rent, utilities, They could have various expenses in here. Remember that revenues are what they make from doing their business, and expenses are basically the cost of doing business. Now, in this example right here, the revenues were greater than the expenses, so they have net income, which is good. Companies want net income. Now, if this was a case where the expenses were greater than the revenues, then they would have a net loss. So, but think about it, that's not what companies want. Companies want to create greater revenues than expenses, and that creates net income. That's what companies want. Now, we would go down to the next one. And again, we do a heading similar to what we looked at before: the name of the company, the name of the statement, in this case, the statement of retained earnings, and the period of time it covers, which in this case is 4-month ended January 31st, 2021. Now, the statement of retained earnings, basically what it does is it summarizes how much earnings have been reinvested back into the business. So retained earnings is just how much is being reinvested back into the business. So the retained earnings statement will always start with what was the balance at the beginning of the period in retained earnings. In this case, since this was a new startup company, there was no balance. There was no balance in retained earnings. Now, typically what happens is if it's a company that's been continuing on in business, whatever you end 1 month with is what you begin the next month with. So typically that is whatever you ended the last month with is going to be your beginning balance in the next period. So the formula for retained earnings is pretty simple. We're going to add net income to that total. We're going to subtract any dividends, and that total, then that is going to give us our ending balance as of the end of this period. Now, one thing I want to say here is why you're subtracting dividends. Remember that dividends are whenever a company shares some of their profits with their owners, the stockholders. So think about it this way: if you're paying money out in dividends, then that's money that can't be reinvested back in the business. You are taking out of your profits to give back to your stockholders. So dividends, since they can't be reinvested back in the business, since they're being given to the stockholders, that is why basically dividends are deducted here. So this gives you your ending balance. So beginning balance plus net income minus dividends gives you your ending balance. And again, the reason you do the income statement first is because the net income is needed off from the income statement, is needed to do or added here in the statement of retained earnings. So income statement first, retained earnings second, and then last would be the balance sheet. Now, the balance sheet is a little bit different statement. The balance sheet has a heading. You notice again the name of the company, the name of the statement, but notice that the balance sheet is as of one moment in time. And think about it this way: the balance sheet is kind of a snapshot of the company as of whatever date the balance sheet is run. Now, the balance sheet, think of it this way: it's really verifying that your accounting equation is in balance. Because notice what's on here. Basically, the balance sheet is made up of the assets, and it just lists all of the asset balances. And again, they're coming from the numbers that we did whenever we put all of the transactions into the accounting equations. We put them all into the account, recorded all the transactions into the account. It's basically just those account balances. And so notice that we brought over the balance from cash, accounts receivable, equipment, and office supplies. We added it up, and so our total assets, let me go ahead and fold this here. Our total assets are $107,000. Now, so then we would come down to our liabilities, and we had accounts payable, so we add that. Then we have basically common stock. We go to equity, and then we have basically common stock, which comes right off the balance of the common stock account, and then retained earnings. And then this balance comes right off the our ending balance and retained earnings. And again, income statement first because we need the net income number to do the statement of retained earnings. Balance sheet last because we need the number, we need the amount of retained earnings to be shown on the balance sheet. And that gives us then basically our total equity. And then notice that total liabilities plus equity, which would be the 2,000 here plus the 105 here, give us 107. And notice again that our total assets equals our total liabilities and equity. So we basically know that the accounting equation is in balance after all the transactions have been recorded to the accounts based on this information. So these are the basic financial statements. And this is a basic example, but this is an example of kind of what happens in an accounting period over a month. Transactions occur, those transactions are recorded to the various accounts, and then at the end of the month, they use the account balances to create the financial statements, just like what we did here. I hope this helps, and have a great rest of the day, and get with me if you got any questions. Take care. Bye-bye.